Part 1 of Colliers Asia Pacific Real Estate Still Good Value in a Changed World research highlights the good value of Asia Pacific real estate by comparing property yields with yields on government bonds and equities. Two key factors are impacting the values of Asia Pacific investments in general. The first is the COVID-19 recession, which should ease from now on. The second is interest rates, which have fallen to record lows. These factors have extended a long global bull market in government bonds. Among core Asia-Pacific investment markets, government bond yields range from 0 for Japan at the low end through 0.8 to 0.9% for Australia, New Zealand and Singapore to 2.8% for China at the high end. Dividend yields on major equity markets are higher, ranging from 1.9% for the US S&P 500 to 4.9% for Singapore. However, dividend yields are at risk from the recession's hit to profits. In comparison, yields of 2.8 to 5.8% for prime and grade A office assets and of 3.5 to 6.1% for logistics and industrial assets in core Asia-Pacific investment markets are appealing. Part 2 of our research examines prospects for rent growth in the various Asia-Pacific property sectors, how those prospects may affect yields, and highlights our preferred markets. In the office sector, despite various pressures, for 2020 we only predict rent drops of over 10% in two cities, Hong Kong, SAR and Manila. Medium-term office rent growth prospects are brighter. Singapore should achieve 5-year average annual growth of 3.3%, with Bangalore and Melbourne not far behind. With a yield of 3.9%, Singapore prime and grade A offices look especially attractive. Firm demand is driving the logistics and industrial sector across Asia Pacific. Markets with 5-year average rent growth of over 2.5% include North China, Seoul and East China. South China, Sydney and Auckland come next. With yields ranging from 4.7% to 5.9%, logistics and industrial assets in these markets offer solid growth for low risk. History shows that sharp falls in the income of the hotel sector after crises are followed by sharp recoveries. Markets where the sector offers strong rebound potential include Singapore and Hong Kong, where prices have fallen sharply. In contrast, while the retail sector was resilient in the past, it faces structural threats that will outlast the current recession. Given varying prospects for income growth within Asia-Pacific property, it is important for investors to understand the risk-return profiles of different asset sectors. In general, offices and logistics assets merit lower risk premiums, while hotels and retail assets merit higher risk premiums. However, the recovery potential of the hotel sector in various markets compensates for the higher risk.